Has anyone ever offered to sell you shares in a privately held company like OpenAI, Anthropic, SpaceX, or Anduril? Have you, as a VC, ever tried to sell some shares in one of your portfolio companies, maybe 10%, maybe 50, maybe all, so you could return your fund faster without waiting for an IPO or M&A, so you could boost your DPI ahead of your next LP fundraise? If you did, then you were dealing with a secondary, not a primary. So, welcome to Fireside with VC. My name is Andrew Romans, and this episode is focused on secondaries. Everything you ever wanted to know about secondaries, but were afraid to ask. So, first of all, I've been doing this for a long time. It's been over 20 years that I've been doing special purpose vehicles, SPVs. And an SPV is basically, like it says, special purpose vehicle. It's like one VC fund to make one investment. And that's often how secondaries are done, but not always. Well, we have 5 VC funds over a couple of decades, and we've learned a lot of lessons and wasted a lot of time, spilled blood and treasure on dealing with secondaries. And frankly, we've been dealing with a lot of secondaries lately. And there's a lot of people that I think believe that they're financially literate, but when it comes to secondaries, they're actually financially illiterate, and they're negotiating against their own interests. And so I wanted to record this episode and try and define a few things that are just facts and legal and help people understand so we can all be more successful in working with each other when it comes to this secondary market. So first of all, what is a secondary? What is a secondary versus a primary? So if a startup is raising money or a scale up is raising capital and they're privately held, a VC like 7BC Venture Capital, our fund, will offer to invest in the company and buy equity in the company. In that case, the startup is issuing stock, and we purchase that stock, and the cash that we wire to the company goes into the treasury of the company to meet payroll and grow the business. That's a primary. Series A, B, C, D, all of that. A secondary is when a founder, maybe an angel investor, an early stage VC fund like 7BC says, I'm on the cap table. On the cap table means they own shares in the company directly, and they want to sell some shares. And they sell shares, cash goes to the seller, and it goes into her pocket. It doesn't go into the treasury, and that's not money to grow the business. That is a secondary. Now, let's get really expert on this stuff. Sometimes the buyer that wants to buy shares in this big, iconic 100 billion mega company, or even a unicorn or decacorn, centacorn, they say, I'm being offered to invest in an SPV, layer 1 or layer 2, and we'll discuss what that means, but I prefer to invest directly on the cap table. I hear this every day. My preference, in fact, I will only invest on the cap table, and I'm unwilling to invest in a layer 1 SPV or a layer 2 SPV. Let me explain what these things even mean. Direct to the cap table means someone who is a shareholder, has a stock certificate, will sell their stock to you on the secondary market. And in order to do that, they need a transfer permission from the company. For example, if you invest in one of our VC funds and you decide you want to sell your shares to your sister and she agrees to buy that from you, as the general partner, I need to authorize that sale. We're not just letting you sell shares to Al Qaeda and ISIS. We want to know who our shareholders are. And we have a legal right to block that transfer. So if you want to do a direct to cap table secondary acquisition purchase or sale, you need permission from the company to do that. So stock transfer permissions. Let's say that you get the permission, then you've got to deal with what's called a ROFR. That's ROFR, all capitalized, and that stands for right of first refusal. So VCs like 7BC Venture Capital, we buy preferred shares, and common shares are the shares that the founder owns. In the UK, they would call that ORDs, or ordinary shares. And the preferred shares have a liquidation preference typically. They have other rights and privileges, one of which is commonly a right of first refusal. It goes to major investors that have major investor rights. Sometimes somebody even negotiates it as a side letter agreement. They want a ROFR. What that means is that you get the stock transfer permission from the company, like, okay, these are great people. We want them on the cap table. So we authorize this. Then the buyer and seller have to agree on price and terms. And once that's agreed, they have to alert everybody with a ROFR. You typically tell the CEO of the company. The CEO emails everybody that has a right of first refusal. And they either exercise their ROFR or they waive the ROFR. We've seen shareholder agreements that say you've got up to 45 days or 90 days to exercise your ROFR or waive it. So your purchase could be tied up for weeks or at least days and days and days. And during that time, things can change very quickly. Very recently, SpaceX was trading at an $800 billion valuation, 800B. And that was a Friday morning. And by that Friday afternoon, it was leaked that Elon was planning on merging SpaceX with XAI. And all deals were off, whether it was getting ROFR'd or not. And by Monday, when it was officially announced from the companies that they had both agreed to that, for the purpose of the exchange ratio of that all-stock merger, Elon valued SpaceX not at 800 billion, but as 1 trillion. And XAI had closed around in only January 2026 at 230 billion post. And for the purpose of the stock exchange ratio of the merger, all stock, they valued XAI at 250 billion. So if you were hoping to buy shares at 800 billion in SpaceX, it quickly had gone up in a matter of minutes and hours to 1 trillion. So waiting to get ROFR'd or not get ROFR'd can completely jeopardize your ability to complete the sale or complete the purchase. Okay. The other thing is a lot of these companies have what's known as the ROFR price, and that's the price to beat. And so that means that the insiders who have a lot more information than the outsider, it's like Gordon Gekko goes to prison in the movie Wall Street for insider trading, but in this case, it's privately held, so nothing illegal. But they know more. They have access to the financials. They're on the board of directors. They know what the sales pipeline looks like. They might be sitting in on meetings with the sales team and the engineers, solving problems and everything. Whereas they have a price that says, we will ROFR anybody that tries to buy shares up until this price per share. So it's like automated for these companies. They're practically publicly traded, although they're privately held, when you have a ROFR price. So if you are trying to go direct to the cap table, you need to get the stock transfer permission. You need to not get ROFR'd. You need to get everybody with a ROFR to waive that in a reasonable period of time. And you got to overpay and beat the ROFR price that the insiders are not willing to match. Now, if you just go and look at who are the big VCs that have a ROFR in a lot of these iconic unicorns, decacorns, centacorns, mega privately held companies, and you'll see that they've raised billions and billions of dollars. They can call up a subset of their LPs and put their own SPV together to ROFR anybody. So if you're not getting ROFR'd, I don't know how proud I would be of myself for not getting ROFR'd against all these people with insanely good access to raising capital in minutes in order to ROFR you. So what is an L1 SPV? L1 means layer one. And so sometimes what you have is a VC fund like ours. We have a pooled vehicle and we bought shares in this startup, maybe at a 5, 10, 15, $20 million valuation. Let's call our entry point is 20 million. And then they raise money at 200 million. And we say, we're up basically 10x here. Do I want to sell some shares and return money to my LPs without waiting for this M&A or IPO? Then they go, maybe we don't do it. Then they raise money at 500 million. And we say, hey, it'd be rude not to. So we create an SPV and we offer, which is in the same legal structure as the pooled fund, and it's a layer one SPV. So the stock certificate doesn't change, doesn't move, doesn't change hands. we just have an SPV that owns the shares from the fund. In a way, it's the shares are pledged or encumbered to the SPV. Now, a lot of these limited partnership agreements may say you cannot encumber the shares in any way. And there's what's happening in practice and what's tolerated. But trust me, this is happening all day, every day, all over the world. Layer 1 SPVs. So the Layer 1 SPV avoids the need for a permission for transfer of ownership of the stock. And there's no ROFR price. There's no getting ROFR'd. It just happens. It essentially stays within the same fund. Now, a layer 2 could be that we created an SPV we invested out of the fund at 20 million. We created an SPV at 500 million. We sold maybe 50% of our fund position to this. So now the L1, layer 1 SPV, owns 50% of the shares our fund ever acquired on the primary, and that's a secondary. And then we create a second SPV that could be a layer 2 that now acquires the shares or the interests of the L1 SPV is now issued and acquired by the L2 SPV. So you've got direct to cap table, layer 1 SPV, L1, layer 2 SPV. Now, sometimes that L1 SPV is another entity. It could be that a big Sand Hill Road VC agrees to sell stock to our L1 SPV at 7BC, and we've made that deal, and it's very discreet. And the VC does not want to be seen to be selling shares. And in fact, they're investing out of their new fund into this centacorn or their new SPV, and the world just sees they're not selling. Often, they don't want it to leak to the press that they're selling. And when the company goes to go public and file their S1, it's revealed, oh, boo-hoo, one of their biggest, earliest investors, like 7BC, is selling shares. It's a bad signal. So we want to be discreet about these SPV to SPV transactions. So it's very common that if you're a lot of financially illiterate investors, family offices, multifamily offices, brokers advising these people say, I only want to be direct on the cap table and I want to go on vacation with Elon Musk and have breakfast with Sam Altman. Trust me, buying $2 billion of OpenAI or SpaceX is not going to get you that kind of access. And it's just going to get you blocked on this transfer of the stock and ROFR'd. Or, way to go, you overpaid that no one was willing to have paid such a high ROFR price to match your outside bid that they thought they lost money with the IPO. Okay? Now, how does this actually work? When you've got the company does IPO and then they survive a 6-month lockup, and now you can sell the shares on the open stock exchange for cash. You can distribute that cash from the fund to the layer 1. And if you were an owner of the layer 1, you receive cash or they distribute stock, which the company allows them to do. Everybody preferred or all preferred shareholders convert into common in an IPO. And at that point, the direct to cap table owner, be that a SPV or a fund that's pooled, distributes the cash or shares to the layer 1 SPV. If the layer 1 SPV had sold some or all to a layer 2, it's the same thing. It just moves over to them. They receive that cash or stock exit consideration. The same thing can happen if it's M&A. The exit consideration is just distributed to layer 1, layer 2. There can be even more. Now, how many layers is good for you if you're the buyer? And the important thing is to say, what's the reputation of the manager of the SPV? Have they been doing this for 25 years? Have they done 70 of them? Do they have other VC funds? Do they have the relationships with buyers and sellers to be doing this? Can they create liquidity, for you? And oh, by the way, what is the layer of fees on these things? Sometimes the direct to cap table seller says, I invested at 20 million. I'm exiting at the same price per share as the current or last fundraising amount. And my revenue model here is that I bought low and I sold high and have a gain. So the gain is all they want. They're not trying to charge additional access fees or management fees or carry. Sometimes you do see a big Sand Hill Road VC sells their shares, and I hope they're disclosing it to everybody in their funds. They then sell the shares to an SPV, and then they sell ownership units in the SPV, and they have a one-time management fee, which can be considered an access fee, or they had a layer of carry of 20% on there, or they had a sliding scale choice. You can pay 5% one-time management fee and 20% carry if you buy into the SPV, or you can pay a 21% one-time management fee and zero carry. So basically, if carry goes to zero or down, management fee, one-time access fee will go up. And if you're lowering that upfront management, one-time management fee or access fee, carry can get lighter and maybe even go all the way to zero. So these are the general dynamics you see. So at the end of the day, it's math. You want to say, is there any promote, or is it just the enterprise value price per share that we're buying into the layer one? If you're buying into a layer two, you better find out, was there carry on the layer one? And if you're dealing with someone who's not able to prove that to you, then you probably should stay away and not do it. So at the end of the day, it's a matter of math. You can say, what happens if I'm flat, not much, you're not making much money, you're just happy to get your money back? What if it's a 1.5x with these layers or a single layer promote as a one-time management fee / access fee or carry? And then you say, well, if it 2x's, now I'm paying 20% of my profit. That's a lot more than my profit on 1.5x. Maybe I was better off paying the higher management fee, access fee, and lowering my carry. If this thing goes 5x or 10x, what was I better off doing? In some cases, they're going to distribute stock, and that's an option. And it could be less of an issue on how that carry is, depending on your control. Which, by the way, brings to what level of liquidity do you have after investing in a layer one, layer two, even layer three SPV? And what layer of liquidity do you have if you manage to go direct to cap table and overpaid and beat the ROFR price? If you invested directly on the cap table, I would argue your liquidity is at an all-time low. The company may just simply say, nope, you are not able to sell and transact, and your liquidity is very limited, and your ability to set up an SPV and market that SPV and find someone to buy your shares might be very limited. Or, God help you, you're dealing with a daisy chain of brokers who are often, sadly enough, charlatans who are not who they say they are, and they present themselves as a family office, but they're not. And so they say that they've got money to buy, and in reality, they're a broker to a broker who knows a guy. So with a lot of SPV sponsors, find out if they're willing to provide you with liquidity and either offer to, if you say, I want to sell something, a small percentage or all of my position in your SPV, they might market it to the other members of that same SPV since they manage it and find a buyer for you. Or they might run out and go to their 20 plus years of being a VC to all their LPs and market it, possibly at a gain, and get someone into a layer two or a layer three. So some SPV managers will continue to add layers of SPVs, providing liquidity, and it's all the same manager, same legal structure, and you never get blocked, which is quite interesting. So the question is, now that you're hopefully more financially literate on secondaries, running around saying I only want layer one or direct to cap table is really negotiating against your own self-interest in many ways. Price, terms, liquidity, ability to get it done at all. So there's advantages on the way in to not get blocked and get a better price, possibly get a very discreet price that's not being shown to many buyers in the market, and massive advantages on liquidity after you've completed the investments. So Sometimes we're the seed investor and we're just selling to our own SPV and we're adding SPVs to provide liquidity and continue to support, basically a privately held company, but meeting the needs of individuals. Some of our LPs were 60 years old when they first invested with us, and now they're getting into their 80s. And it's more suitable for them if they know that they're liquid. And we can't guarantee a gain, but we can definitely hopefully, put in that effort to find someone to buy them out at a gain, flat, or even at a loss, which might be better than I can't sell anything. And the IPO is going to take some time, and there's going to be a lockup after we all convert to common and nobody can sell. Sometimes you're dealing with an ocean of brokers. So what is sort of the good, the bad, and the ugly? A little bit of the ugly on this is that it happens to us all the time. Somebody reaches out to us and says, "Oh, I heard you have an SPV for this, and we would like to buy $150 million of that, or 50 million, or 5 million, or $500,000. And they present themselves as a single family office, an SFO, and say, "We are the principal," or they say, "We're an MFO, and we provide services to lots of family offices. So we're a multi-family office or a wealth manager." And then you find out they don't have a website, or their website is confusing. And when we say, "Okay, we'll sell you shares in this thing through the L1, L2, whatever, at this price," and all of a sudden we don't hear from them for a few days because they're running around trying to find an actual family office to come up with the money. It's happened to us. I mean, this first happened to me many, many years ago when it was Pinterest was the big company. So that kind of dates how old we are into this. Somebody called me up, cold called me and said, "Oh, I see you're really good friends with Brian Cohen," who at the time was the chairman of New York Angels. And they said, "We see he's listed as the first angel investor in Pinterest. Could you help find a block of sellers? We have a buyer that wants to buy 200 million of Pinterest, and they want to do 50 million first. And once that trade goes through and we have proof of shares and proof of funds, we'll do another 150 million immediately at the same price." Well, I call up Brian. He's a great guy. We get together a whole pool. I remember First Mark was in there. There was a whole bunch of VCs. We put it together. We've got 200 million of inventory now to sell to this guy. And he was so lazy that he emails me back the same day saying, "Hey, Andrew, I've got 200 million of Pinterest. Do you want to buy it, or do you have any buyers?" We were like, "Oh my gosh, this guy is a total charlatan. He's pretending to have a buyer when he was just fishing, putting out a big reel, a big net, trying to see if he could find inventory." Then turns around and says, at this price per share, at this EV, enterprise value, I've got inventory. Who wants to come in and contribute 200 million? So we've seen it on both sides. Someone pretends to have inventory. They don't. They're trying to find a buyer, or vice versa. So it can get very messy. Very often, the person that represents themselves as a, MFO, SFO, principal, very high net worth individual is actually a broker. And when push comes to shove, they say, "We only invest in real estate with our family office. When it comes to this stuff, we bring in the other families that we buy real estate with. We own half of Orange County together. Trust me, they only want to deal with me." This is a liar and a charlatan and a faker. So you end up dealing with a broker who says, "I'm direct to a buyer." And when you push them and get to know who they really are, they know a guy. And that guy was a liar telling them. So you end up with a daisy chain of brokers that have no idea who the end buyer is, and they have no idea who the end seller is. They just know the daisy chain broker to their right, the daisy chain broker to their left, and it gets very time wasting and messy. When they finally figure it out, they'll say, "Let's manage the broker chain," and the one-time access fee going to broker dealers or just to these opportunistic brokers starts creeping up to adding 21% as an access fee to the EV base valuation that you're buying in at. So if you're the seller, you want to stay away from these people because they keep talking to you, telling you stuff that's not really true, and your deals are falling apart. When it comes to close, you signed an LOI and they're gone. No one's showing up because all those brokers don't even know who the end broker was. And we've even seen it when buyer and seller came together. It was the same buyer as the seller, and they were selling from an earlier block, and they have other buyers they were bringing in. So they were willing to buy at a higher price than what they were selling at. And all these confused brokers put all this Aix-en-Provence roundabouts led back to the same individual entity or person and no deal. So it can get pretty messy when you get through, and you can waste a lot of time. For us at 7BC Venture Capital, we've got a flywheel strategy where these different pieces fit together very nicely, where we're not soliciting anything here, just saying what our business is. We have a fund of funds where we've raised capital from LPs and we invest in emerging manager VC funds, typically in their final close, seeking that the value of their existing investments in that fund have already gone up and they're at final close, and we get a 2x fair market value increase at the time that we invest. So we're looking for VCs that have already invested in companies at whatever valuation. They've already raised at higher valuations. We look through net of up and down, lost, up, flat, and down, that if I put in $5 million, it's worth $10 million at the time that we go in. If you put in $10 million, it's worth $20 million at the time we go in, and we hope that fund will grow from there. When we go through all these VC funds in their final close and look at their portfolio companies, it's creating deal flow for our direct VC. So our direct VC says, well, I didn't invest in your fund because I didn't believe in your TVPI being 2x, but I really like that company. I'd like to invest in their next primary when that comes along. We might even cold call that CEO if you don't get a warm introduction, or we'll buy a secondary off of the VC, buying 10% or 50% of the shares, buying their preferred shares, which might even come with a right of first refusal, ROFR, and a pro rata equity right to invest in future primary rounds. And we're providing DPI distribution to that VC emerging manager ahead of their next LP fundraise. So it should be much easier for them to get everybody, all their LPs, to re-up into their next fund if we help them return money without waiting for the IPO or M&A. So we have a FOF, fund of funds, that invests in lots of VC funds. Then we have a direct fund that cherry picks getting into the outliers and their best ones. And then we've got a pre-IPO fund that invests in late stage funds where we've got access to lots of large Sand Hill Road VCs we've known for decades and decades, since the late 90s. And then we know thousands of emerging managers. So if we see a company that's late stage that we're interested in, we typically have brokers out of the way and direct access to the preferred shareholder that might be highly motivated to provide some liquidity for their guys. So that's how, and then very often these are SPVs ourselves that we're managing. So it's FOF, invest in VCs, cherry pick with a direct VC, and then late stage pre-IPO investing via a pooled vehicle fund and SPVs. So I hope this has been helpful, and I hope we can all be more successful in the secondary market together. Bye for now.